Welcome to Beat the Markets.
I'm Ritger.
And I'm DKM. So Ritger, when I was a trader back in the late 90s, there was one book, or one author that wrote two books that was, you could say, the gospel of trading. And when we were getting started, we all read this book and learned a lot from it. So I thought it'd be fun if we went through each chapter again and kind of talked about the book, how it applies today, what held up, discussed it a little bit, see what we can get from it. I guess almost two and a half decades after.
Let's do it. Yeah, Market Wizards by Jack Schwager.
This is the book. Let's see if it still holds up with time.
It's like the Bible for traders. It'll always hold up.
So we'll start with the first chapter, and we'll do Market Wizards, and then the second book was New Market Wizards. So let's start with Michael Marcus. We'll go topic by topic of what I guess we found interested, we can alternate. One line that I thought that was interesting was Jack Schwager and Michael Marcus are discussing all the aspects of trading, and where he's at right now, he says trend following is doomed to mediocrity. And you know, that's interesting in a lot of ways. One is that I found a lot of traders I speak with, they're able to isolate something or isolate some way to make money, or they're making money and they're doing something, but you always think it's going to end. And I could see Michael Marcus was in this way, that he benefited from, and maybe we can get into that, but he benefited from a trend, which was he was in the commodities market, and as the price freezes were coming off during the Nixon era, Nixon price wage freezing, as the freezes were coming off, the commodity prices were popping, and he was good skills he developed, but in a good market at a good time, and he became a winner. But he kind of saw the writing on the wall, and thought that trend following, as he was employing it, was doomed to mediocrity. So I have a lot more to say, but any initial comments on his view there?
You know, I noticed that quote on trend following too, and there was a follow-up though. He said that it was the particular kind of trend following that they were doing back then in the 70s and 80s that he thought wouldn't work anymore. Richard Dennis' system that he used with the turtle traders had stopped working. Dennis, I don't know if he had a blow up, but he had a 50% drawdown at one point, stopped trading. So that particular set of rules had stopped working, and rather than say that trend following was completely dead, he did admit that in certain cases when there were giant forces, like a readjustment of a currency market, or supply and demand in a certain commodity, like oversupply of oil, a big drought that hits the grain markets, that kind of thing, you could still have these big trends. So the big change that he noticed was that breakouts started failing more often. Now in trend following, you see something trading within a range, it makes a new high, you buy it, new low, you sell it short. If it retraces, you close the position, you take a little loss. And he seemed to be saying that when that these breakouts kept failing, like he'd take little loss after little loss after little loss, whereas in the 70s things would really move. They'd break a trend and then they'd go sky high. He was exclusively trading long at the time, except for one accidental trade where he closed more than he had and ended up short.
Right.
But that was an interesting comment. But it shows that the rules, the particular parameters that work, may stop working over time. So you may have to rejigger the parameters. But here we are 30 years later, and trend following has worked great. It's still been one of the most winning strategies over that time. I mean, the majority, I think, of the top 10 traders, top 10 firms, investors, period, including Warren Buffett, are more or less trend followers.
Right, so we have the benefit of hindsight, and we see that guys like Jeremy Parker and Bill Dunn have come out of the trend following world. Bruce Kovner come out of the trend following world, and they've done fabulous well. So we know with the benefit of hindsight that it worked. You know, to not to belabor the point, but you know, with Richard Dennis's situation, I've heard that sort of he had these rules that he blew up because he didn't follow his own rule. Mm-hmm. So, and I don't, you know, I'm not privy to the details of what happened there, but that was one of the things that he mentioned, was that as proof of why trend following wasn't going to work, was that he had Richard Dennis blew up. You know, the thing that you mentioned though, unless, you know, I felt like it was almost like a throwaway line, but it was an important line, which was that unless there's a very powerful force that can overwhelm everything else.
Right. I mean, prices are never going to be static, and you know, in capitalism, prices are constantly adjusting. You know, this is it's an irrational process. You know, prices move because they move, but
Soros says it's constant, it's feedback, and they're trying to figure out the truth, but you know, it's in search of.
But there's overshooting and undershooting, but the prices are never going to just find their perfect level. It's
and
not
to
like,
just be at perfect equilibrium, you know.
No, so they're always going to be moving relative to one another, and there will always be trends, because, you know, oil will always be going from, you know, $15 to $150. To get there, it'll make a trend.
You know, that's my, you know, to me, trend following has to work. Like, okay, in Michael Marcus's case, I think he was kind of doing like 4-day trends, and so that can change.
Yeah.
But the concept of a trend has to work, because in order for you to make money, or anybody to make money, whatever reason you get in, I think I've talked about this in another video, it has to go from point A to point B.
And it's not random.
And if you can identify the movement and get into a healthy chunk of it, you have to make money. The key gets to the other part, which we'll get into, but is how do you make your losses minimum relative to your winner, or the trend that you capture. But the you know, one of the reasons why you also said it wasn't going to work was that it's a crowded space. And it always feels that, okay, things can get crowded. But trend following is one of those things it just conceptually so strong to me that it has to work, because things have to get from point A to point B, and if you cut your losers and maximize your winners, like, that's a very strong, robust trade approach to trading. You know, so there's one other thing was, you know, one of the other, which is interesting in today's world, was the other reason that it wasn't going to work was because how much governments and central banks were getting involved in currencies. And I thought that was really interesting, because that's one of the complaints with investors today, is that it's become a politicized market, or the Feds, you know, the central banks are heavily involved in the markets. And it kind of goes to show that, you know, these things are always there, and, you know, there's always winners and losers, and it really comes down to us as the trader and how we approach it. It's, you know, these other things are, you know, we can blame forever. There's always, you know, the Chinese or the North Koreans, or, you know, or Janet Yellen, or whoever the
he also said he didn't believe in conspiracies in the market, and I don't either. I mean, you hear this a lot when it comes to precious metals and oil. I don't know. Maybe it tends to be like associated with far-right politics too, especially in America.
Right.
People say, oh, it's the central bankers repressing gold, it should be 5,000 an ounce. Or, you know, we're running out of oil, or who knows? There are all kinds of theories associated with why various commodities should be higher, or why the dollar should be lower, or why the stock market should be something else, or interest rates should be different. But markets are just bigger than any one actor. I mean, I don't discount the ability of, you know, a central bank to come in and influence things at the margins, or powerful, influential parties to issue, you know, strategically timed press releases, and maybe they move prices. You know, they can make something gap up on an open or down or whatever, but I don't think they have the ability to sustain a big trend. This is kind of going off the topic, but the big one right now, the big theme here right now, obviously, is the bull market we've had in U.S. equities. People say that it's supported by the zero interest rate policy that we've had since the start of the Great Recession. And well, it's not verifiable. Like, yeah, we've got a stock bubble. It's a great bull market, but we've had these before. We've seen them elsewhere at times when there hasn't been a zero interest rate policy, and in other countries that haven't had such a policy. So who's to say? I mean,
yeah, the why is almost irrelevant.
It's not. You can't even say that it's correlated because it's a one-time thing. I mean, we've only got one giant bull market during zero interest rate policy. So. Right.
I mean, this is in the realm of even if you have a why, then how relevant is it in future investing?
I mean, if we don't have 1,000 years of history with 100 instances of the Fed doing ZIRP.
Right. So we don't.
So who's to say? Maybe we just have a bubble because we have a bubble. People feel like buying stocks.
Right. There's something out of the other, the third great book, The Reminiscences of a Stock Operator. So to anybody that's an aspiring trader, if they're still exist in this world, they might all be trading cryptocurrencies. But I would say it's Market Wizards, New Market Wizards, Reminiscences of a Stock Operator, and one of the lines out of that book was it's not wise to ask why, and
yeah, you just go with it.
So now this is let's go to one of the things that you found interesting in the book.
Okay, sure. Let me glance at my notes here. What kinds of misconceptions about the markets get people into trouble? Well, I think the leading cause of financial disablement, this is Marcus, is the belief that you can rely on the experts to help you. It might, if you know the right expert. For example, if you happen to be Paul Tudor Jones's barber and he's talking about the market, it might not be a bad idea to listen. But typically these so-called experts are not traders. Your average broker could be a trader in a million years. More money is lost listening to brokers than in any other way. Trading requires an intense personal involvement. You have to do your own homework, and that's what I advise people to do. So, a tip might tell you when to get in or to get in, but they're not going to tell you when to get out. Like, I really hate giving one-off tips or advice because, well, you don't know how people are going to implement it. They might not trade the right size. The trade might change. The signal might change before they get into it. I mean, the whole financial news industry is based on this. So and so from XYZ traders or fund who might have $500 million under management likes this because, and he'll give you his little thesis, but you don't know how that plays into his overall strategy. You don't know what his real signal is. He might be, he might be looking at, a technical breakout using price alone, but he'll give you some theory that involves, geopolitics. Or you just think about the geopolitics, you read the newspaper, and it's just no way to trade. You got to have a hand. You got to have your own signals and your own systems.
So, this is a really fundamental point, and it's very hard to think in the mind of why people do this when after doing it for so long, we clearly know we don't do that. And you say, well, tips the person, maybe he'll tell you when to get in, but you don't get the call when to get out.
Yeah.
But I remember the time frame when I thought probably more like the layman, and I got a story with this one. So, you graduate, you're in your last year of college, and you're trying to get a job, and my buddy helped me get an interview at Brown Brothers Harriman, which I don't even know if it's people even know the bank today, but it was an old school small partnership, pretty prestigious bank. I think George Bush Sr.'s dad was a partner there, and anyways, long and short, my buddy helped me get an interview there, and I went for the interview in their research department, and I don't even remember how the interview went, but I remember like seeing the notepad on the head of the researcher's desk, which was like something positive about Union Pacific. and and you know, so I went home and I was talking to my dad, and my dad's like, you know, you get the job. I'm like, no, I didn't get the job, but I got a stock tip. You know, the research, the head of research really liked Union Pacific, and he went out and bought the stock because, you know, I thought that person really knew something, and my dad thought I mean. He didn't, you know, probably didn't put a ton of money on it, but he, you know, but we, you know, but you think that there's experts in this world, and
in reality, that analyst was probably told by the investment banking team to come up with something positive about Union Pacific.
Right, come up with something positive, or we have too much inventory of Union Pacific stock, and we'd like to, you know, lighten our risk, or even maybe you know, the director of research was a female, maybe she really liked the stock, but how does she know better than really anybody?
Yeah, what's their hit record? I mean, great traders can have a 70% lose record. It's just that their winners outweigh their losers.
Right. Even if she was a great research person, and her success rate is 70%, I could be getting that, you know, taking the 3 out of 10 that's bad at that Union Pacific.
Exactly.
So it's a bad way to approach. But the layman really thinks that there's people that know things. And I got a lot of points to this. You know, when people, you know, as I evolved and people knew you were in the markets, then people ask you for tips. And when I was younger, I used to just give them because you don't know better. And I remember there was a friend of mine, and she said, you know, I have some money, which was earmarked for medical school or whatever. And she's like, you know, but until I go to medical school, you know, I should invest the money. And I said, yeah, you know, I gave her a couple stocks that I like. Now I'm a day trader, you know, so, but you know, I don't know that I don't really know anything. And I give her some, you know, I give her like my favorite stock to trade. I love trading this stock, and I gave her my favorite stock to trade, and she went and bought it. And this was like September '98. I don't know if you remember. I mean, you remember the market, and that was like whatever it was called, the Asia flu crisis, or the Russian ruble crisis, or whatever it was. There was a crisis in September and October '98.
Russia defaulted, the Thai baht devalued.
Yeah, right.
It was like our 2015. There are a lot of parallels actually. But go ahead.
And the market, and yeah, there are a lot of, and that stock got cut in half, and I was like, oh my god. She just lost half her medical school money, this, that, the other, and I was feeling pretty bad, you know, pretty bad, and you know, I met her, you know, maybe 6-7 months later, and I asked her like how did it work out, and the stock, not knowing it, but the stock, you know, went from 20 to 10, and then it was like in the 80s or 100s, and she was feeling great. She was like, yeah. I did my research, you know, I took the stock, I did my research, I bought the stock, and it fell down, but I knew, like, you know, I knew it was a good stock, and you know, and then she was really happy. It was a lot. But the lesson I learned from that was, if it never recovered, I was going to be a bum.
Oh yeah.
And the fact that it did go to 80 or 90 is her genius.
Yeah.
So this, you know, if you're a trader and people ask you for tips, don't give them. So I learned never to give tips. Mm-hmm. But then people think you're holding out on them. People think you know something and you're just being a jerk because you're not telling them. Anyway, this is really, you know, off the point, but I think, you know, to bring it a little bit more to the point. One other thing is that, you know, as traders, you know that nobody knows nothing and there's no gurus. But, you know, even we think that, you know, you go to other, at least you go to other industries, and this is my parallel to, I guess, how the layman thinks, that they know what they're doing. So if something happens to me where I need legal advice, I think, okay, well, I'm gonna hire a lawyer. They know best, and I kind of outsourcing the thinking and the burden. But they're just like, in my opinion, they're just like the broker that really knows nothing. Like, nobody knows anything. I think, like, in every industry, 85% of the people know nothing. And so, that's my parallel. Like, when we could go hire a lawyer, and all the traders have this all the time. They go to a lawyer for some reason or another. If you've been around long enough, my friend says that you haven't arrived until you've been in litigation. So I don't know if that's true or not. But at some point, if you've been in business long enough, maybe you'd have to end up with a lawyer, and you think, and your initial interaction with them, you think that, okay, I got this expert, he's going to help me, and you find out they don't know it. They're no good either for, a host of reasons why it doesn't work. Number one is that unless you're their number one client, they can't give you the attention, right? Meaning a lawyer has a fixed number of, apologies to my friends that are lawyers, but they have a fixed number of hours in a day. And they have families and they have a life and they have to prioritize things. And you're not number one on their priority list, right? It's their family or maybe, or the number of their top 1 or 2 clients. Mm-hmm. And and that's if they're competent. But assuming they're like everybody and mediocre, they don't really know any better than anybody. And that's why.
So the same with the medical profession when it comes to a lot of things, drugs, diet. I mean, look at the advice we were getting for how to eat for 30 years. It turned out to be dead wrong. The data was there, but that wasn't the dogma. We had a narrative, and that's what the profession was saying for all that time. It was causing diabetes and obesity.
This isn't reference, I mean, specifically
low fat,
high carb, yeah. And it was supposedly the study was sponsored by the sugar industry or something.
Yeah, this was dogma forever. But there were studies. There was plenty of data that showed there was very little data to support it, and also the link between serum cholesterol and heart attacks. Very little data to support it, but it was like dogma. You couldn't question it.
I remember vaguely about this. There was one scientist that was questioning. He completely got marginalized. I wish I knew the story.
That's always how it is. I thought of something. Instead of giving tips, we should give them aphorisms. Don't fight the tape.
That's a good one. That's what, I think that's what J.P. Morgan, right? They asked him what the market will do. It will fluctuate. So that's the solution to how to get around if they think you're holding out on it. Soros used to have this problem. Soros used to have this problem. People ask him for tips. He's Soros, and what he used to do was ask him how much you have, how much money you have, and people usually get offended by that. He goes, "How do you expect me to give you advice if I don't know how much money you have? You're asking me a personal question. I'm asking you a personal question." I don't know. That might be it's a humorous story.
It's a little obnoxious. I'm not surprised.
Yeah. Well, that was kind of. I guess he took it as an affront, and he responded, obnoxiously. But
speaking of aphorisms, the one that comes through in every interview in both of Jack Schwager's books is. It's basically don't fight the tape or cut your losers and let your winners run. I mean, every guy says this. I mean, they all went through this process, and they all have the same story, it seems. I guess a couple of them started winning from the start, but for the most part, these are guys who failed at least once. Michael Marcus, I don't know how many times he'd scrape together anywhere from $1,000 to $50,000. Put it all in one trade and lose it. That seemed to be like the first several years of his career.
So there's a lot of knowledge in that, which is that it takes iterations to get it right and to really know it. The fortunate thing with traders that do on little and relative, it's all the money in the world to him at the time, mm-hmm. But it's great that he learned it on relatively little money.
What you're learning is emotional discipline. You're learning to override, that tendency to stick with a losing trade. That's all it is. Like in every single instance, that's all it is that people have to get over. They get into trades that are too big, number one. They overtrade. I mean, he would get wiped out like in a single day. He's trading futures, and he'd buy the maximum number of contracts that he could with with futures you can use huge levers. So you could have a $5,000 account and buy $100,000 worth of something. It falls 5% in a day, which would happen sometimes, and boom, the account's gone. So they trade way too big, and if they're not wiped out all at once, they'll get wiped out slowly because they won't close the damn trade that's going against them.
What was interesting on Michael Marcus in the case? So that's most people's natural instinct is to hold on to the loser. But Michael Marcus was really interesting to me because his natural instinct when he was trading with his college buddy.
His first day trading, he had the right instinct.
He had the right instinct.
He was just trading too big.
Yeah, he was trading relatively too big, and it was funny. He was measuring his success by the number of days it took him to lose money. So like the first time he lost the money in a day.
That was like instant.
And as they got better, it took him like 4 days to lose the money. But he had the right instinct, like which I thought was really interesting. That he, when he started losing, he would get out.
Yeah.
And what was also interesting, though, in his unique case was he needed somebody to teach him how to let it ride. How to let the winner ride.
Yeah.
And that was Ed Seykota, which we'll cover in another chapter.
Seykota would never sell. I mean, something could go higher and higher and higher to crazy levels, unthought of levels. This is the inflationary 70s. So these commodities went through giant spikes, kind of like Bitcoin this year, to unheard of prices. But Ed Seykota wouldn't second guess it. He'd stay in the position until it turned, and then when he turned, boom, he was out.
Ed Seykota is a fascinating guy, which we'll cover in a future episode. But one of the things that I thought that was interesting, I don't want to spend too much time on him because we're going to cover him in detail later, but was how Michael Marcus said, I didn't understand how he knew so much at a young age, and that was him and Buffett are two guys that are fascinating to me. That how they had so much knowledge and wisdom in the markets in their 20s. Whatever little I think wisdom I've accumulated is through trial and error and making a lot of mistakes. And Ed Seykota, these guys that just somehow, and it's more than instinct, because it's Michael Marcus had some instincts that were good, but he didn't have a cohesive what's called conscious competence. Right, there's like 4 levels of skill. Is like the lowest level is unconscious incompetence. Then there's unconscious competence. I forget, but unconscious competence is like there's people in the world that are talented and good, but they don't know why they're good. And then the highest level is conscious competence.
I'm going to take a stab at it, knowing a little bit about Buffett, Munger, and Seykota. They're both real calm guys. They're all calm. I would say that they have a low time preference. They're patient people. They have this quiet confidence in themselves, and what they're doing is not particularly complex. I mean, Buffett, he just read Ben Graham and said, "Oh, you look at the balance sheet and you make sure they're earning money steadily and." Okay, it's a business I can understand. It was nothing complicated. He had the conviction and patience to do it. He didn't need the company to go up right away. He was okay with the stock falling. He would add to a falling position. He would stick to his picks. I mean, he would stick to them long enough for them to return. And with Seykota, he would just stick to his system. I mean, it wasn't complicated. Basic trend following trading, basic trading. Something starts to move, you take a position, you stay with it until it turns. They didn't have that frenetic angle, that frenetic aspect to their character that almost everybody does when there's money on the line. They were just a bit more zen about it. I think that was the secret. They were probably just born that way. Yeah, you could say it's strength of character, which is developed through discipline. I mean, you're probably born with a genetic predisposition or not to develop self-control and discipline. These guys had it.
I don't know in Seykota's case if this applies, but that's a really good point. The other thing with Buffett was he had the discipline to stay in his knowledge base and not to which it's enormous his knowledge base, but also not to get caught up in I guess other newfangled things.
Right.
There's a lot of great, and that's the thing about trading is like you can have this discipline forever, and you just get caught. I love Stan Druckenmiller. I mean, he doesn't know me. I love, but I love him. I admire him. But he got caught up in the tech boom. Somewhat of his stature, got caught up in the tech boom and got hurt. He was managing quantum fund for Soros at the time, and they I think the fund got up to 18 billion, and it went down to, I think they lost $8 billion in 2000 when the tech imploded. So even if someone of his stature and of his pedigree got caught up in the tech mania, so in that sense, Buffett to not get swayed with the times is something something to note.
You don't think that that lack of that cool-headedness applies to Sakota?
Oh, well, I'm sure it does. No, the cool-headedness, no doubt. I don't know to what extent how much Sakota's done in trading, how much he's expanded. Buffett's a public figure. Very few people outside of trading know Sakota, so I don't know what he's done outside of markets. Like, does he take all his trading money and then he buys? I'm sure he doesn't, but buy Bitcoin with, or he expands. He's expanded his so-called game into doing other things, and the other things don't work out. With Buffett, we know that he's never really deviated from his knitting.
Sure.
And I know the bulk of what Sakota does, I'm sure he hasn't deviated from his knitting. In fact, I still follow his work, and he helped me. When I got off track, I can tell you all the things that take you off track. And what takes you off track is you start, you get away from the knitting because you start, I call it believing your BS, which is that, it's convoluted, like, success begets success, and you think that you can be good at everything. And so you don't consciously think it, but you have the Midas touch here, and you think the Midas, whatever you touch will have the Midas touch.
Michael Marcus got into trouble in his investments outside of trading.
And that's something I want to talk about in detail, even though it's a little bit pulling the cart before the horse in terms of for traders, because you want to talk about getting rich before worrying about how to spend it. But I think it's a valuable thing that I don't know if we'll get in other lessons, and it's something worth covering. But yeah, that happens, right? Is that you think you have the Midas touch here, or the money doesn't, whatever it is, and you start getting, and it's natural to get involved in other things, either for diversification, or you get pitched all the time because people think you have money, and you got to sell things to people that have money, and people are human, and most people get interested in the exciting new thing. Like it's human nature, and so Ed Sakota, from what I got, is a very wise man, and I assume he didn't. I know the bulk of certainly what he does didn't get caught up in that. I don't know to what extent, because so much of what he does is private money and unknown, what he's done. But Buffett, we have a clear track record that he doesn't get caught up in the newfangled gizmos and widgets or whatnot. But it's good, you bring up a good point, which is temperament and character have a lot to do with because it's numbers, people think it's math or it's being a genius, but I think Buffett says something along the lines where once you have a certain IQ, it's good enough. It's not about how smart you are, or it's about I don't know, this is I guess again to how important character is. When J.P. Morgan, when he was subpoenaed before the Congress in whatever it was, 1900 something, they asked him, what do you look for in a loan? He goes, the first thing is character, and they thought he was being, I think they thought he was being a smart ass, but he was probably giving a genuine answer there.
No, as far as I could tell, he was.
It's J.P. Morgan's got some great quotes, which we got to cover the great people of history too, at some point, but which we'll do. Let's.
So what else would you like to cover?
Okay, so this was, we dovetailed it into the last thing, and like I said, I want to talk about what Michael Marcus did outside of trading, and I said it's a little bit pulling the cart before the horse, because we're talking mostly about trading and how to, and the world of trading, and is it really relevant to discuss what traders do in the outside world? But I think it's valuable insight what happened to him, and to the extent it's really difficult to learn from other people's mistakes and lessons. But if we can do it, it's a great thing. So I do want to talk a little bit about what Michael Marcus did. So what Michael Marcus did was he made a lot of money. It seemed like he made a lot of money in trading. You know, to put it in context, I think when he started working for Commodities Corporation, it was like a $300,000 account.
30,000.
Oh, sorry, $30,000 account, and it became 80 million.
Yeah.
And I don't know what the payout.
He said he basically doubled his money year after year after year. I don't know how many years it was. And Commodities Corporation would take 30% of his profits. And he said 30% of his profits went to support his bad investments, like his California real estate. He said he didn't know how he managed to lose money in the bull market at the time. And his airplanes, I don't know how many airplanes he owned.
Right, between the government, he said between the government taking 30%, his real estate taking 20 or 30%, and his real estate taking 30%, his planes taking 20%.
Yeah.
He cut, and then he just decided to cut it all. But so there's an aphorism in that, right, where if it about not spending your money in things that are depreciating assets, which but real estate's not supposed to be in that category.
And in the end, he determined it was better to rent planes than own them.
Right.
And to stay put in California, he said he bought a nice house on the ocean, and he stopped flying around the world looking for thrills.
Right. Or he said something along those lines. He said he realized that you didn't have to own a home in every great place in the world.
Right.
That's one of the things that mystifies is not the right word, but amazes me, is that just how many great places there are in the world. And I was in Scotland this summer, and it's a beautiful place, and Edinburgh is a beautiful city, and there's just some beautiful homes, and Edinburgh is just one city in the world, and there's just so many. That's the world. There's a lot of things in the world. Not that I want to own everything, but you just can't. But that's what makes the world. That's what makes the world great, is that there's just a lot of people doing a lot of things and living a lot of different ways, and you can taste it and enjoy it. But
yeah, you can't have a home in all these different places, because a home means a community. It means an investment. I mean, like an investment of your time, a commitment to the future of a place, coordinating with other people who care about the future of a place. I mean, that's what a home is.
Right.
And you can't have 10 homes.
Right. But in his case, what probably happened was that he would go somewhere, fall in love with it. It's beautiful. He's making a lot of money trading. He's like, it's just a months of trading.
Walk into a realtor's office and go look at home, go look at houses.
But I do want to spend a little bit of time on this, because there's this notion of we've seen young people, for one way or another, a lot of it through athletics, come into a relatively large amount of money at a young age, and then they lose it all. And there's this idea that they were just foolish with money, and I think it can happen to anybody. Like, I think that's why there's an important lesson. It's even somebody who's a good trader and has a facility with money is doing but he's young, or it's the first go around, and you don't know, and in his defense, in today's world it's very easy to say that, because it's easy to just rent a plane. In his days, maybe you didn't have net jets, or even now these you can just pay per use for private jets. You actually had to buy them. It's getting out there, but on a side note, some of the things that happen are a function of time. And I met a year ago, I think I told you this, Brett Hull, and he was one of the guys that was on the blackjack team with Ed Thorpe. And a lot of these super intelligent guys, Ed Thorpe and Brett Hull, instead of approaching and using their quantitative and systematic minds, the markets were approaching the blackjack table. I never could understand that. I'm like, why are you thinking so much about the blackjack, such a low stakes, when you could be employing that rigor in the markets, where there's no table limits, nobody's trying to kick you out, no one's trying to break your knees. And he said it was, you have to remember, this was the 60s, I think 50s, 60s. Like, it was expensive to buy a seat on the floor of the exchange. Like, the cheapest access, you couldn't just open up a TD Ameritrade account. You had, the cheapest thing to employ was the blackjack table. Now that they're both much bigger, I think Ed Thorpe doesn't even care at all about blackjack because it's such small potatoes. But so there's a lot of lessons we can take away from the enterprise outside of trading. I don't know what you say other than I guess just be more the way he I guess it comes out of this. He said he approaches investments emotionally and he didn't analyze anything. And I guess the same rigor that you take to anything in your life, if you have some success, apply it apply that rigor and discipline in anything you do. I guess is the broad lesson. When money's coming in, you're like, it's just a few bucks, it's not worth it. But it's not worth it, or you get cavalier with things. But this is when Ted Turner it happened all around the same time. He made that big donation to the United Nations, and then AOL got acquired. Time Warner, and he became he was already rich, but when AOL imploded, his net worth really imploded. And I guess one of the interviews asked him, said something, well, you're still worth like $1 billion or $2 billion, whatever it was. It's still a lot of money. Like, what are you worried about, right? The journalist's not going to know. But Ted Turner's, I guess he's like, I lost like whatever it was, like $4 billion or $2 billion. Like, it's a lot of money. There's a lot of better things I can do with that money. And I guess that's the lesson, is that small amounts of money can add up. Drops of water fill the ocean.
Yeah, you gotta respect that money, no matter how much you have. You
no matter
respect it.
Yeah,
It's capital. You can do things with it. It came out of other people's pockets if you got it out of the markets. So you have a responsibility to allocate it well, use it well. You do, no matter how you've acquired a fortune, but it really drives it home when you've made a fortune through trading, because it's a zero-sum game. I mean, it's one thing if you create a business, you create an industry, it employs a lot of people, it provides a service, a product that didn't exist before, you brought something to life, right? So that in itself is de facto valuable if you've gotten rich through it, unless it's some kind of a scheme, which there's more and more of these days. But so much of Silicon Valley, you could say, is, what are they really doing? It's just waste of making money from advertising. But trading is zero sum. You can't kid yourself about where that money comes from. You're not. Yes, speculation serves a useful purpose. Liquidity in the markets, it's oil in the gears of capitalism. But for every trade that you're a winner, in futures contracts, like we're talking about today, that's as plain as it gets. If you're long a position, you enter into a contract. It is a contract to deliver, 100 ounces of gold in December at this price, and you're buying the gold, and somebody else is, you're agreeing to buy the gold at that price. Where's gold right now? Is it 1,300?
It's dipped a little bit low, but it's around 1280.
1280. Okay, you agree to buy 100 ounces of gold at 1280 an ounce in December, and this other guy, you don't know who he is, somewhere in the world, agrees to sell you that amount at that price. A couple months roll by, and you settle up. Money, it goes into his account or it goes into your account. It's direct.
Right.
So when you've acquired your money that way, it just makes it really stark. You haven't created anything. You've acquired it through skill or luck, but you haven't created anything, and yet you've got a pile of cash. And to just go and blow that on ego-inflating purchases seems, it's hard to justify.
But then that's where the aphorisms, which easy come, easy go.
Easy come, easy go. It's true. It really is true. It doesn't seem to matter how you make your money. And it shows in how it shows. Yeah.
let's leave that topic. I think you summarized it well. So let's go. Do you have another topic you want to?
Let's see. Let's see. There are very few traders who have been as successful as you. What do you think makes you different? I'm very open-minded. I'm willing to take in information that's difficult to accept emotionally, but which I still recognize to be true. For example, I've seen others who make money much faster than I have, only to wind up giving everything back, because when they started losing, they couldn't stop again. Cutting your losers short. When I've had a bad losing streak, I've been able to say to myself, you just can't trade anymore. When a market moves counter to my expectations, I've always been able to say, I'd hoped to make a lot of money in this position, but it isn't working, so I'm getting out. He talks about how when a position's going against him, when he's losing consistently, he'll feel like he's lost his mojo, and then he'll just stop trading for 3 or 4 weeks. And he said, or he's in a position, he gets in a position, and he doesn't feel right about it. Like, he doesn't feel the way he did when he thought about getting in once he's in. He said he found it to his advantage to just get out, close the position, sleep on it. And when you're out of it, when you don't have any money in the market, you can think clearly. It's so true. It's hard to think clearly about a trade once you're in it. So, I mean, we're talking about a discretionary trader here. I mean, he's not following a strict system. It just shows you. I mean, he had some real problems with nerves. At one point, he was so nervous. Somebody recommended some like heavy sedative.
Oh,
he came to the office and like fell in the elevator and went home.
Yeah, or when he got
barely made it home.
And he was
he missed the day at work. He had to go home.
Yeah. That was one of the things I noted too, was how much the stress of trading was getting to him. But I think I don't specifically remember what was the event, but was it that he missed out on I think it was like he felt the stress because Ed Sekoda was making all the money in the soybean,
right,
and he broke his rule or something,
right,
and wasn't in that bull move. And I thought that was interesting. He wasn't feeling the stress because he was losing. He was feeling the stress because his buddy was making the money and he wasn't in on that trade. And I think
he had gotten out on a whim.
Yeah, and he got it. And I think that's there's a lot of points to bring up, but that's one of the things I think that disturbs me most as a trader is not the losing or making and losing, which nobody likes to lose, but it's really when the thing that I hate the most is breaking discipline. That's the cardinal sin. Is that a word? Is that his phrase? Yeah. But that's the great sin. And because in trading it's par for the course. You're going to lose. There's going to be losers. But breaking discipline of your rules. There's no how do you, if you don't live by your rules, what do you have?
It's true. It's true.
So there was a couple other points to that. Just can you refresh my memory as to what was the line of this? I mean, because we got off on the drugs he was taking.
He talked about how he would walk away.
Oh, getting getting his position. Yeah, there was some things I thought that was interesting in there. Was that he would just stop trading, and I think that's one of the things that's important in trading is to get smaller. If it's not working, just get smaller. Steve Cohen, I use this a lot. Is when you don't know. I don't do discretionary trading anymore. Everything's systematic. But what I did was, when you don't know what to do, just at least cut it in half. Cut it in half, because what happens is if you're on a whim, you get out of everything. Then you're kicking yourself. Should I have done this? Should I not? You cut it in half. Okay, then you begin to start thinking clearly. You can then, the next day comes and you can get out of all of it, or you can get back in, and you can always buy it back. And I think that's an important, couple important points in that is that along that vein, I think also he said was, if you get in a position and you just don't like it, just back when they use brokers, like don't be afraid to call the broker up and just get right back of it. And Schwager followed up with that, like, you mean like you don't want to feel stupid in front of the broker? And he said, yeah, basically, but that's human nature, right?
The broker's not going to care. He's going to get 2 commissions.
Yeah, he's sending you a thank you note. But I thought that was, you have to be, this was it. For the larger point is that you have to have an independence of mind and sort of be open to new information and not be married to
Exactly.
a position. And I think that's a skill set that's really important in trading. This is a more philosophical point, and I don't know, but I wonder how, that personality that really works well in trading, how good of a trait is it in other aspects of life? Because to build a bit, for example, not to bring it into things that are too unrelated, but in order to build a business, I think you have to have the total opposite trait. Because you build a business, it takes maybe will take more than a cycle, and you have to go through that down cycle and have the fortitude and wherewithal to manage it through the cycle and not cut your loose.
Exactly. You have it's grit. It's sticking through it, forcing your idea to become reality, which does not work. That's guaranteed to drive you bust in the markets.
Which is the to me is it's ironic that what's an important skill set to be successful in one area of business is not.
It actually became a popular philosophy in the .com 2.0, the Web 2.0 era. Peter Thiel talked about this in 0 to 1. In the .com, the original .com boom in the late 90s, we had a surplus of optimism. Everybody believed in their company and their idea. It didn't matter if it was a bad idea. They just believed in it. They talked it up, and the stock went up. And then, I don't know what percentage of those companies went bust. It was probably over 90%. The NASDAQ fell, 85%, almost 90% maybe. So, in the rebound from there, people were tentative. You had this startup culture that was about failing fast, iterating, trying new things, and staying lean, and failing fast. Like it wasn't forcing some great idea into being. It was like, keep trying something until something sticks. Don't put a lot of effort into any one. And Thiel said this is completely wrong. Like, we were doing it right the first time. That's just how things have to happen if you're going to force something new into the world, something big and new into the world. And that's the Peter Thiel approach, or the Elon Musk approach. You say, well, Musk wasn't trying out little things. He thinks of something that needs to exist and makes it happen. Puts all his money on it and makes it happen. Or Henry Ford, he knew what the Model T should be, and he was maniacal about bringing it into existence. He knew what a factory should be like. Or Steve Jobs, he knew what the iPhone should be like. So anyway, it's a great skill to have as an industrialist, as a businessman, but you want to tread lightly when you're a trader. Hold your opinions very lightly. If the world shows you that you might be wrong, get out of it. Change your mind.
It's well put, well summarized.
Because you don't have any control. You're surfing. I mean, it's this. The markets are this complex system. You can't predict where they're going. You really can't. Like, there are patterns, yeah, but they give you a slight edge. It's more about how you trade those patterns, how you control your own risk, trade small, and how you act when something goes against you, and how it goes with you. How you act how you act when you have timed it right, and how you act when you have timed it wrong. It's more about how you react than predicting what's going to happen.
Absolutely.
We've mentioned this before, but Andreas Klenow, he's a trend following manager author. He's demonstrated that you can manage a winning portfolio that enters positions randomly. It'll pick stocks or futures contracts and go long or short at random. And the entry, it doesn't matter that your entry is random so long as the positions are managed according to rules, according to the same old rules of don't take too big a position, sell it if it goes against you, stay with it until it goes against you.
Yeah, there's there's a craft to it that that shows that if you know this craft aspect, you can apply it in regardless of what the signal or the signal is.
It's a humble. It's the opposite of bringing something to creation, of controlling the world, of ordering matter and energy and people and work. It's just humility. It's just you're just surfing waves. You can't control that wave. It's all about how you handle, dancing on something that's bigger than you.
The thing, maybe this is not the scope of the show, but the thing, I can't synthesize in my head is how that's a critical skill set in trading, and I think the most effective skill set in trading. But if you would apply that in other aspects of life, like nothing would get done. Nothing, like the world wouldn't work.
Yeah, you'd be walked over. I mean, you've got to exert your will out in the world, but your will is nothing in the markets. I don't care if you're the Federal Reserve. You can set the discount rate, but that's about it.
And some people say you can't even set the discount rate; they just follow the Fed funds rate.
That may be true.
This is something I thought that would be valuable to the listeners. Kind of, I think Schwager asked him what advice you have for traders, and he gave some advice for traders. So I'll run off his advice, and we can comment on that. So they said his first piece of advice was to always bet less than 5% of your money in any one idea. That way, it takes you a long time to lose your money. So
that's good advice. Classic trend following model that we've seen. Risks. It's hard to know what he means by bet less than 5%. I mean, if you have.
I think
does this mean?
I know what you're getting.
Yeah. Does this mean by, if you have 20 stocks, is that enough, or does it mean lose 5% if you're wrong? It probably doesn't mean lose 5% if you're wrong, because you want to lose far less than 1% if you're wrong.
Yeah, I think the way futures guys don't talk in this way, but he almost talked that it seemed like as an allocation, like 5% to corn.
Yeah.
And don't put any more than 5% of your capital into an idea.
And it doesn't mean 5% in corn and 5% in wheat, because they're correlated.
Right. I've done that when I younger. It's like you make these hard rules, and then you really want to get a trade, and you kind of like try to muscle in
oats and another 5% rice.
You muscle in an extra some extra percentages, and you're diversified by the book, but you're not really diversified.
Actually, we talk about this a lot in our strategy. People think they're diversified because they own a big cap fund, a small cap fund, a mid cap value fund, a big cap growth fund, but they're all just U.S. stocks. Put them all together and they add up to the S&P, which, it's diversified. It has every industry in the U.S., but does the S&P have foreign stocks too, ADRs?
I don't think so.
It has multinationals anyway. Even if you buy a total world stock fund, they're still just stocks. So
there's a correlation. I want to spend a little bit of time on this aspect of his advice, is that it's wise advice to avoid going broke. I mean, diversifying prevents disaster.
Yeah.
The challenge is it's hard to make substantial amount of capital, especially if you're an independent trader and you're trying to grow your trading account and you're living off it. It's hard to grow the account being very diversified. So traders tend to have made their initial grub stake through some sort of concentrated bet. So the money gets made through concentration. But at some point, if you want to keep the capital, or you want to manage outside money, I think you have to you have to step into the world of diversification, and that'd be advice to the in my time we were in the NASDAQ in the late '90s, and if you were in the right place at the right time, and walked away with some money, you know, you just being in the right place at the right time, and then you got to turn around and I call it making it real. And you know, maybe it behooves those the cryptocurrency beneficiaries to look. They made a lot of money. They're in the right place at the right time. An older person such as myself, you know, I was talking to a friend of mine who's, you know, was trading with me and earlier today, and you know, we've seen a few bubbles, and he's working on trading a cryptocurrency, a platform to enable cryptocurrency trading, and he's some really young guys that have benefited from the cryptocurrency boom working for him, and they keep saying how great it is and how it's the future, and he keeps telling them like, listen, all, you know, bubbles burst, like it's not a bubble, you don't get it, and long and short of it is that, you know, he didn't benefit from the boom, and nor have I, because you know, you get skeptical as a trader. You know, you see so many things boom and bust, and you know, you get skeptical, and so, you know, we didn't benefit, but people have, and that's, you know, and at some point you got, you know, everyone's got to decide for themselves, but you got to make it real, and the way to make it real is to diversify, and then use that pot of money. This is the key for trading. Is if you had the beneficiary, use that pot of money to, now you have to go through the transformation, right? You got the capital, but you still have to develop the skill set to actually be a trader, because you got some of the pieces of the puzzle, one important part being capital, but you don't have the craft developed yet. And if you don't develop that craft, the capital is gonna get taken from you. And I think, you know, that's one of the things in Michael Marcus's history was that, you know, I see the pattern repeat is that somehow you get involved in the markets, and you know, it was him, his college friend exposed him to it, and you know, everyone has some different way they serendipitously came into it. They kind of were the beneficiary of a, you know, other people are, you know, saying it can't be done, and they're doing it. Like, I'll say cryptocurrencies don't work, you know, but there's somebody out there doing it, and they're in the place and they're doing it, but while you're doing it, you have to, the ones that are able to learn the art of trading are the ones that are then able to move on after that game ends.
Which comes down to risk management. Either make it real through diversification, which anybody can do, piece of cake. Diversify by asset class and just leave it alone, or control your risks through, well, hard quantitative rules, position sizing, and cutting your losses. That's how you make it real. That's how you can ensure that your stake is going to last as long as you.
I you know, made a lot of notes, but I think we, you know, did this for a while, and we, you know, covered some interesting points. Do you have anything you particularly want to highlight?
I'd just say it's I mean, this is old school. Market Wizards was written, I guess, in the 80s.
89, I think it was
89,
published.
yeah, and it's talking about guys who, you know, who made their fortunes in the 70s and 80s, mostly as discretionary traders. And so, you know, I haven't picked up this book for a while, until today, but looking back on it, you can see just how hard it is to be a discretionary trader, and how the common denominator among all of these guys is risk control. And so what's happened since is that these rules have been, these common denominators, these particular rules have been distilled out from years, from people, you know, from the blood, sweat, and tears of putting it all on the line with big positions and you know, big egos, and it's so it's fascinating because this, I mean, these guys are the you know, discretionary trading still exists, but it's, these guys came up with all the rules that we use today as quants. They learned them just through trial and error.
Right, and that, you know, I mean, I'm always grateful for this book because the lessons they learned maybe I learned quicker. I learned them myself, but maybe you learn them a little quicker.
Yeah.
I mean, I literally would read this book every night and trade
Wow.
and trade and I feel like a lot of lessons got hardwired. Sometimes later in life you deviate because you forget.
Yeah.
But
we need aphorisms to help us remember, not tips. We need aphorisms.
And one thing I want to highlight before we wrap it up, one of the things I thought was interesting was, it was a small group at the time. So Michael Marcus was trading with Bruce Kovner, who we were going to cover, but ended up becoming a household name in the world of hedge fund management. Who he transformed into a trader and then made the next level jump.
Sure.
But and Ed Secoda, who he was a trader, who's the quintessential trader's trader. But the idea of being in a fraternity or being I think it's important to have a group of people to work with. It is a very independent profession, and you have to have independence of mind. And it's kind of like you do fly solo and you live and die by your own sword as an independent trader. But I think it's helpful to be part of other guys or other people that are doing it, because you need that feedback. It's if you're isolated in yourself in a room, you can your mind can take you anywhere. You can deep. And not to go back to Scotland, but one of the things I thought was interesting was how Edinburgh was a hub of like economic. The foundation of economics. Adam Smith's from there, and Hume was from there, and there's something to be said. Silicon Valley today is kind of like a hub. There's something to be said for attacking these unknown this world with a team. I guess.
Absolutely.
So I got nothing else. Rick, are you?
No, that's it. It's a wrap.
Thanks for watching.
See you next time. Don't forget to like and subscribe.